Hi everyone, thank you for joining us for this quarter's market review. My name is Jit Hwee, I'm Client Advisor at Provident. Glenn, our portfolio manager, will be sharing with us what drives the market in the last quarter of 2025. I'll now hand over the count to Glenn.
Hello everyone, my name is Glenn. I'm a portfolio manager at Provident, and welcome to our market review for the fourth quarter of 2025. In this market review, we will go over some of the global market performances that happened over the fourth quarter of 2025. Next, we will discuss some of the performances in our funds that we hold in our portfolio. Next, we will also talk about some key market moving events that happened over the quarter, and there have been quite a few of those in this last quarter. And finally, we'll finish off with a discussion on what to look out for in the first quarter of 2026, which has already started off with quite a bang. So without much further ado, let's get right into it. So if you look at this chart, you will see the global equity market performances over the fourth quarter. And the first thing we can see is that most of the performances over the fourth quarter were broadly positive. The key difference between this quarter and the previous quarter, which is the third quarter of 2025, is that the performances were not as strong as quarter three, which was a very, very resounding quarter. So if we look at the United States over on the right, the return for the fourth quarter was a 2.6% return. And that is a very respectable return, but not as high as the previous quarter's 8.6% return. So considering the strong three quarters that the United States has shown, and considering the tariff storm that we went through in April and May of last year, and that is a very good full year result for the US equity market. Next, the most striking highlights in this chart would be the very strong return you see over here, with a 23.06%, and that's coming from Korea, and a 12.34% return in Taiwan. And this shows that the trend over the fourth quarter of last year has really been concentrated in EM markets. And these are both tech-heavy markets, which have done extremely well based on the AI trade that's ongoing and the AI tech spend, capex spend, etc. So elsewhere in developed Asia, we can see the STI pulling in a very respectable as well, 8.68%, on top of the gains that we have already seen in the third quarter. And if you look at Japan, it's also a very respectable 8.8%. So it has really been an amazing year for Asia. If you look at China, it's all come in at a very good 3.8% for the Chinese market. And that's after a 20% increase in the third quarter. So all in all, China has done very well this year. The Chinese markets have done very well this year, despite what's happening in the Chinese economy. And finally, we have a little bit of a weaker return over here in Hong Kong, in the Hong Kong market. And this was also on the back of a very good third quarter return. And there was some profit taking in this market. And this was largely driven by a couple of declines in the tech heavyweights of Alibaba and Tencent over the quarter. So all in all, despite being not as good as third quarter, it was still an amazing return result for equity markets. And this topped off a very, very good 2025 for equity markets worldwide. So next, we can have a quick look at fixed income markets as well. Generally speaking, news were quite quiet over the quarter, and there were some larger moves that we could pay attention to. If you look at the light blue line, you can see that these are Singapore yields, and they moved up decisively above 2% over the quarter. And this was a result of some stronger than expected economic performances that we saw in November and December, and also a stronger than expected inflation report that we saw in October. So inflation came in at 1.2% for year-on-year for October, and this was well ahead of expectations. Despite this, it wasn't enough to get MAS to upgrade inflation and growth forecasts significantly for 2026. Nonetheless, traders were still very cautious and moved yields decisively up 2%, up above 2%. Japanese yields also rose higher over the quarter, and we also saw Australian bond yields rise over the quarter. And this was primarily due to higher inflation in these economies. US yields were largely sideways, and yields in the European Union were also sideways. So this chart also shows where global yields sit at relative to the rest of the world. In the lower regions, we can see it's bunched by a few countries, namely Singapore, Japan, and China, with China having the lowest developed country, lowest yields in the bond market at the moment because of their ongoing fight with deflation. In the middle, you can see the EU. and where their yields are trading at right around 2%, 2.8%, I beg your pardon. This is because they are seeing modest growth and also low inflation. So nothing really much has happened over there. And right at the top region, you can see the traditional higher yielding markets of New Zealand and Australia, with the US following closely around 50 basis points behind. Next, we can talk about a little bit about the fund performances of some of the funds that we have inside our portfolios. And you can see from this chart, there is a big difference between two different sorts of funds. On the equity funds, we can see that it is a very strong performance quarter for all of our funds. In particular, the Dimensional EM Large Cap Fund came in at 5.1%, outperforming the Amundi Core MSCI Emerging Market Fund, which came in at 4.29%. So if you recall our slide earlier, it's still all about the EM markets for the quarter. Dimensional funds performed better of the quarter due to the performance of the various fundamental factors like value and small cap. If you look at Dimensional Global Target Value Fund over here, it came in at 3.76% for the quarter, beating the developed market benchmarks, which was around 2.86%. And this is because the Global Targeted Value Fund is quite heavily weighted towards small cap and value, and thus the reason for 3.76% over the quarter. So it was a very good quarter for the equity funds. On the fixed income side, it hasn't done as well for the quarter. Generally speaking, yields have gone slightly higher over the quarter, and as a result of some currency impacts as well, fixed income funds were largely flat for the quarter. Shorter duration funds did slightly better than longer duration funds, which came in at a slight negative for the fourth quarter. So we'll now talk about some key market moving events that happened in quarter 4, CY 2025. Although the quarter was a positive one, some investors must have felt that it seemed very tumultuous. It seemed like a very uncomfortable quarter, and there were two large volatility spikes. So this discomfort is actually very understandable. On October 9th, which seems like a long time ago now, there was actually a reignition of the trade war over China's rare earth export controls. There was a lot of miscommunication or misunderstanding went on during this period of time, but which escalated very rapidly over the weekend and into Monday and Tuesday following the initial escalation. But in this case, to the market's relief, it actually resolved a lot quicker. So the big players, the United States and China in this case, were a little bit more sensible. By the end of the week following the initial escalation, the markets have recovered all their initial losses, which were quite large. And by the end of the month of October, markets were already making a new high. Nonetheless, investors were rightfully feeling discomfort during this period. The next volatility spike can be attributed to the ongoing AI trade as well, and it was all about AI in November. First, there were some debt concerns about some players in the AI sector, namely Oracle, CoreWeave, and these companies were all involved in building out large data center infrastructure to facilitate the expected AI usage. So at that point in time, in November, there was a lot of debt issuance from these companies, and this debt issuance caused credit spreads and credit default swaps to rise quite rapidly in the quarter, and triggering some contagion fears that the sector and these players may not be able to repay these loans if the future of AI was not as rosy as expected. So this drove a widespread decline in AI-related companies and created a lot of volatility in November as well. And following that, it was not over. So following that, we had Google announcing its new AI model, Gemini 3.0, which saw a very good take-up by the market. Particularly its image generation capabilities were very, very welcomed by the market. And this should have been something good for the AI industry and AI companies. But unfortunately, the market, being in a bit of a bearish mode, decided to see this as something negative. They felt that this would take market share away from OpenAI's ChatGPT. And OpenAI and ChatGPT was actually responsible for a lot of the CapEx expectations involved in the infrastructure build-up. So the market decided to sell off any company related to ChatGPT's CapEx plans. So that again brought some contagion to the AI sector. Of course, a lot of these fears are a little bit front-running, a little bit overstated at this point in time. And in December, there was slightly a more positive catalyst, and I would call it memory is the new gold. because the market moved on from infrastructure, data centers, and funding AI capex to the key essential picks and shovels needed for building out these centers. And memory, DRAM, high bandwidth memory, manufactured by the likes of Samsung Electronics, SK Hynix, and Micron, became the new focus. DRAM prices rose several times over in the past few months, in the last quarter of 2025, and these drove the share prices of these memory manufacturers up tremendously. As you can recall earlier, we looked at our slide and we saw Korean markets and Taiwan markets moving so decisively. So this memory trade actually propelled a different sector of the US tech sector to move up, and this actually made up for some of the underperformance in the AI big players that we saw in the months earlier. And lastly, the Federal Reserve also contributed to a little bit of volatility in the markets. The market expectations for rate cuts were, prior to October, quite set in for a cut in October and a cut in December. But at the end of October, Fed Chair Jerome Powell came in. He did deliver the October rate cut, but he also had a hawkish statement in his press conference following that, where he said that the future path of rate cuts was not certain. So this was what we call a hawkish cut, and the market took this quite decisively and downgraded rate cut expectations quite severely through October to November. And over the course of the month, you have other Fed officials coming in saying one thing and another, causing quite a lot of volatility in the interest rate expectations market, and also causing the market to move up and down exceptionally as well. So in December, we finally had a decisive statement from a more influential Fed official that they were comfortable that a December rate cut was appropriate for the economy, and the market once again moved its rate cut expectations for December back up to where it was before October even started. So we took a big round trip in rate expectations. The December rate cut was delivered as expected, but throughout this process, it caused a lot of volatility in the market, and this then caused investors to get a little bit uncomfortable over the quarter. So with the fourth quarter of 2025 and a very good year in 2025 behind us, what can we look forward to in the first quarter of 2026? Excuse me. Now, 2026 has just started, but we have had a very noisy start to the year, particularly from the Trump administration. If you look at the table over here, you can see that we've been 3 weeks into 2026, and we had a whole list of announcements from the Trump administration already. On January 7, we have the administration banning institutional investors from buying single-family homes. We have them directing agencies to purchase MBS to push rates lower, which is good for the economy. And in January 9th, we had the military operation in Venezuela, which we talked about at length in another video. And obviously, this was very disconcerting for markets as well. Finally, and most recently, over the last weekend, we have the whole Greenland affair, where the president and the administration threatened to impose tariffs on European countries, NATO allies, if no Greenland deal is reached. These tariffs are supposed to start from 10% and escalate to 25% in June if they don't reach a deal on Greenland. As you can see, when it comes to not just financial developments, we have now political developments developing as well. So this obviously sets a very noisy tone for the markets, and we will see as a result of this a lot of volatility in the market. So investors have to be prepared for this and accept it as a part of life in 2026. So across the economic backdrop, we do see a constructive fiscal and monetary outlook for the second half of 2026. A lot of spending plans will kick in. Interest rates should continue to go slightly lower as inflation continues to fall. But investors will need to navigate choppy waters for now. We can see, as per 2025, the first half of 2025, early part of the year is very much what we call Trump season. There's going to be a lot of announcements, there's going to be a lot of reactions, and the markets more or less will react accordingly. But we ask investors to keep a close eye on our underlying economic backdrop and hang around, stay comfortable for the second half of 2026, which is likely to be better. Right, so that's the end of the video. Thank you for listening. As always, we appreciate your trust. Please feel free to contact us or contact your client advisor if you have any questions. Thank you.
Thank you, Grant, for sharing with us very insightful market review for the last quarter of 2025. Now I will take the opportunity to share with you what does it mean from a financial planning perspective when markets are at all-time highs. If we look back at year 2025, the most notable event was that of Liberation Day, when President Trump announced wide-sweeping tariffs affecting all major trading partners. It immediately evoked memories of Smoke-Hawley Tariffs Act in 1930, where there was global retaliatory tariffs leading to widespread economic hardship. Who would have thought that at the end of the year, all the major metals and indices would have soared to new highs? So this clearly shows us the fallacy of trying to make market predictions, especially over a short-term period. Given the markets have climbed to new heights, naturally most investors are concerned about what does this mean to them. Let's contrast the forward-looking returns after the market has declined by more than 10% versus the scenario where the market has climbed to new heights. Looking at the average annualized returns of S&P 500 for the period 1926 to 2023, after the market has declined by more than 10%, you'll see that on a forward-looking basis of 1, 3, and 5 years, you'll still see very robust returns ranging from 11.5 to 9.6%. What about if markets have climbed to new heights? Similarly, you see that on a forward-looking basis in 1, 3, and 5 years time frame, again, we have robust average returns ranging from 30.7 to 10.2%. This is not surprising because on the long-term basis, the market is on upward-looking slope, underpinned by 3 strong fundamental factors. The world economy is growing. There is increased productivity with diffusion of technology, innovations, and best practices. And globally, central bankers are targeting inflation rate of 2% to anchor inflation expectations and to guide inflations. So all these are very strong, powerful factors that drive the markets over the long term. Broadly speaking, there are 2 groups of investors. You have those who have already accumulated their wealth and those who are still accumulating their wealth. So for those who have already accumulated their wealth, what does it mean to time the market? Naturally, if you are able to time the market, let's say you are able to avoid a market drawdown of 20 or 30%, your overall portfolio returns would be enhanced by 20 to 30%. The big question is, are we able to do this on a sustained and reliable basis? Let's see what the data says. Morningstar did a study by looking at 3 investment strategies. The yellow denotes an indexation strategy where they just invest into an index without any asset allocations and market timing. Red denotes active fund managers who do bottom-up stock selections with moderate level of allocation. And blue represents active fund managers who specializes in asset allocations. They're always trying to look out for market dislocations to take advantage of market dislocation by adjusting asset classes mixes. So what does the data tells us? You see that surprisingly, the professionals who are supposed to be proficient in making asset allocations fared the worst, followed by the active fund managers, and indexation strategy actually do the best. So while it's very tempting to try to make adjustments to your asset class mixes based on changing market data, often it turned out to be a worse outcome. So if we were to zoom in on the annualized returns on a 20 years basis, doing active fund managers who specializes in asset allocations underperforms an index strategy by a massive 2.7%. Now let's turn our attention to accumulators. Does it matter if you have a different strategy in terms of deployment, doing a lump sum investments versus dollar cost averaging and versus putting it in cash? Vanguard did a study by looking at the MSCI World Index returns from 1976 to 2022 and calculate which method is superior based on the 1-year market returns. They discovered that a lump sum investments will outperform cost averaging 68% of the time, and a cost averaging strategy will outperform cash 69% of the time. Charles Schwab also did a very interesting research where they asked, what if we have 5 hypothetical investors with very different investment styles, and we asked them to invest $2,000 over a 20 years period? Peter Perfect was a perfect market timer. He's able to invest at the lowest point each year. Ashley Actions took a very simple approach. She simply invested the full amount on the first day of the year. Matthew Monthly employed a dollar cost averaging strategy by dividing his $2,000 investment into 12 equal portions. Rosie Rotten had incredibly bad timing. She invested at exactly market's peak each year. And Larry Linger left his money in cash, always trying to wait for the next big opportunity to invest in stocks. So how do they fare? As expected, Peter Perfect has the best outcome. But what's surprising is that Ashley Action, Matthew Monthly, and Rosie Rotten have identical or similar results that are not too far off Peter Perfect. And most importantly, even for Rosie Rotten, who has such bad luck, her total returns and portfolio size at the end of the 20 years is at least more than 3 times that of Larry Linger. So this tells us that for an accumulator, it doesn't really matter whether you employ lump sum investments or dollar cost investing. It doesn't matter whether you have good luck or bad luck. The more important point is to stay invested and not to be too conservative by staying in cash. Given the 100 years history, they are able to repeat 80 separate 20 years rolling periods starting in 1926. And the rankings were the same in 70 periods. Even for the 10 periods where the rankings were not the same as expected, investing immediately never came in last. In fact, for most cases, it's just simply swapped with Matthew Monthly. So in conclusion, it is futile trying to make market prediction, especially over the short term. And the most reliable way for you to achieve your goals is to firstly have a comprehensive plan that takes into account all the important elements, which include your insurance policy positions, your assets and liabilities, and your cash flows, both present and future. It's also very important to determine and align the risk profile of each of your goals. For example, your children's education goal, your financial independence goal, with the most suitable asset allocation. And as the evidence suggests, we should invest as soon as possible using a globally diversified portfolio. This concludes our sharing. If you have any questions or thoughts after this, please feel free to reach out to your client advisor, and we are more than happy to speak to you. Thank you.